Hey guys, it's Crossroads here. Today I want to talk about the broader market in this big pullback that we had today. I want to give some context, I want to tell you what I've done and what I've not done as well, and we'll go from there. So first, we can see that there was a massive drop in the market today. This is a heat map. And when, it's not too uncommon when you see some red in the market, but on this size, especially with some of these larger names, it can give you pause and you start to wonder what exactly is going on and whether you should do something about it. Of course, Nvidia is down about 5%, Apple down 3.5%, Broadcom down about 6%, Tesla down 5%. A lot of high beta names like HIMS, BMNR, Robinhood down close to double digits or just past double digits as well. And yeah, there was some green with consumer non-durables. McDonald's held up today. Utilities did okay here and there. But it was a big day down in the market. And of course, the broader indexes, the S&P 500 and the NASDAQ as well, ended up dropping immensely. The NASDAQ dropped 3.5%, and the S&P 500 dropped 2.7% as well. These are pretty big moves, but they are not the biggest moves that we've had all year. So let's take a look at some of the context. Actually, first, before we do, let's talk about why. So this goes back to the same reason why the market dropped in April. President Trump posted something on Truth Social early this morning, and he said that talks with China were not going well regarding trades and, of course, tariffs. They had discussions, of course, back in April. They ended up having some early discussions and then saying, okay, let's put a pause on changing anything more from here. And Trump talked about raising massive tariffs. Of course, we know how this ends. China will not just say, okay, fine, go ahead and tariff us. It's good. There will be retaliatory tariffs. There will be a lot of saber rattling as it relates to economic warfare, not really physical warfare. And I expect that things will actually be resolved at some point. Now, it may take weeks. Of course, Xi and Trump were supposed to meet in about 2 weeks. It seems like that perhaps that is off. We have the whole weekend to kind of digest this news, so we'll have to see. But if so, that's not great. It's one of the reasons why the market is taking a pause. The other is we had run up immensely as well. And so let's take a look at this. This is giving us some perspective. There's a saying in the market, when in doubt, zoom out. And you can see that we're still up pretty massively on the year. The S&P 500 is up in almost 12%, 11.5% still, despite the drop. The NASDAQ is up 15.5%. Of course, you could say, Roy, we were up, nearly 20% on the NASDAQ, and we were up nearly 15% on the S&P 500. Yes. Now, a couple of things to look at. Now, first, we can see that there was, of course, a much larger drop here earlier in the year through April until we bottomed here and during tariff lows. And we've risen from, negative 18% on the year at that point, all the way we're up here. A lot of the tariff stuff did get resolved. Is this a big deal with China? It is. This is a major trade partner for the United States. And there's incentives to work out things on both sides. China, I don't think, honestly, was taking things very seriously. And it may take, some pressure and some time as well for them to actually want to come to the table and be reasonable. Trump also likes to, I would say, exaggerate. Can't think of a better word for it. Exaggerate both repercussions and also how dire things are. And so don't be surprised if we see a little bit more noise on that too over the next coming weeks, or this might be resolved fairly quickly as well. We have the whole weekend, so it could be that they talk and they say, hey, we're still going to meet in 2 weeks, in which case the market will probably rally, but maybe not back to where we were before, because there'll still be some uncertainty until things really get settled. Now, let's look at a few things and indicators just to see how big this move is before we talk about what to do and ramifications. Now, this is the relative strength index. Relative strength index is basically looking at these massive volatility moves and shifts and change over time. Now, usually, not always, when the price is going up really rapidly, RSI goes up. And when it goes down really rapidly, RSI can fall off a cliff as well. And we've seen that this has fallen off a cliff. Now, this band right here is what most people use, which is RSI on the daily basis. Now, you can use it weekly as well. We will look at that in just a moment. But on the daily basis, when it's over 70, which it has been, just several times, and it can do that in a bull market. We tend to actually be oversold and comfortably oversold, or excuse me, overbought for a while in a bull market, and in a bear market as well, which we're certainly not in. We can be oversold for a long time. Here is, that context back in April that there was a time period for not even a week that we were pretty far oversold. We were oversold also briefly up here as well. Now, these things can happen. If we zoom out over the last 5 years, we can see that persistently we have been in a very strong bull market. There have been times when, of course, back in 2023, when we dipped below, we see in 2022, of course, it was a bear market. But even then, it did not like going underneath 30 RSI for very long. Let's actually look at this from the weekly time frame, because I know some do look at that from the weekly as well as monthly. I tend to not use monthly at all. And here's the weekly time frame as well. We'll zoom out over 5 years. We can see where we were. We were actually overbought on the weekly basis. And you can see that usually, even in raging bull markets, it tends to not be overbought forever, that there are pullbacks along the way before it resumes. And we saw this, of course, in 2024, saw this in the middle of 2024 as well. And until recently, this is actually the first time we've seen it on the weekly time frame. By the way, nice little bounce you can see right here off the weekly RSI. If you do see, and it's not World War III, this go down, we have a long ways to go. It's still actually a little bit hot on the weekly. But let's say this takes months to shake out, and the stock market actually keeps falling. Maybe it falls back to its flat on the year. At that point, we may be looking at being oversold on the weekly time basis. That's almost always a good indicator that that's a great time to buy and get in. Again, it's not financial advice. Do what is right for you, but we have a long way that we can possibly drop and go. Again, on the daily basis, we are a lot closer there, but you can see this is a lot more choppy and noisy. But do pay attention to that. It's something that's worth considering as well. Now, beyond this, we have the Fear and Greed Index. Now, this is on CNN. There's a couple other places where you can look at this, and I do apologize for the ads. Fear and Greed Index overall is influenced by a number of factors. We can see that there was a big drop as well. That previous close was at 49, so basically just in neutral. And we've been in neutral for a little while. A year ago, we were in greed, doesn't really matter. And so we've shifted from neutral to fear on a couple of momentum indicators. So one, of course, is the S&P 500, and it's 125-day moving average. And we are in fear, not extreme fear yet. Stock price strength as well. And so this is basically looking at the entire index broadly, so the New York Stock Exchange, the number of stocks at 52-week highs versus those on 52-week lows. And it's actually neutral. It would get all the way to zero and actually not even above. As long as it doesn't go above 5%, or below 5%, it's considered neutral. So this will be neutral for a while, even if we continue dropping, just because many stocks were very elevated, including the ones that I hold and own as well, and likely that you own too. Stock price breadth, and this is the breadth on the actual market. If things are very concentrated or broadened, that influences this. So we're now in fear, put and call options. This, I think, is probably one of the better indicators. It's basically what's the ratio of puts to the ratio of calls on market. Now, usually there's a lot more calls than puts on the market. There's very rare times that we can see back in April when there were just as many puts as calls. Puts are, of course, a downside bet. Usually calls are an upside bet as well. So this is rare. And as things go down more and more and more, it shows a lot of greed. And we're still in greed, that people even today didn't buy a whole bunch of puts. Now, if this continues, we're going to see something like what we did in April, where there's a bunch of put spot that can put some pressure on the market as well and bring things further down. But there's a limit as far as how high things go, especially in a bull market too. And then market volatility. This is the VIX and its 50-day moving average, which we're going to look at in just a moment. But we can see the VIX, it spiked immensely here. This is when you get massive drops and massive moves in a day. These are pretty rare. Of course, the yen carry trade was one last year that we experienced back in August. That was a massive shift in VIX. And usually the way that the VIX works is you can take these moves in context. So if today, just from this one message, and of course, let's be honest, like part of this is a pullback in the stock market as well. If we all of a sudden saw this spike up to past where it was in tariff times, when it wasn't just an issue with China, it was an issue with everybody. And also, I think the whole strategy that Donald Trump rolled out with tariffs, I think that implementation was very confusing, very flawed, and very scary at the time as well. I didn't buy the dip nearly as aggressively as I would have. But if this was anywhere near the size of that, I'd be like, oh man, it is time to buy. This right here doesn't spike and spike for long. Now, here is the VIX as well, just on through CBOE. You can look at their site to see the actual, which does take into account some other factors as well. But here are showing those moves as well. In fact, let's do one better. So here is the CBOE VIX index. You can view this on a number of different trackers and tickers as well. And we can see this big spike. Is this scary? Well, no, not really. This is actually relatively small. Now, if you look at it on a very tiny time frame, it looks big, but let's zoom out. Now, here is April's massive bounce. Yeah, this compared to this is nothing. Now, for whatever reason, it's not showing today's move. And it would be up in past the 20s as well. We're at 21.66. Now, 31% change is a pretty big move and shift as well. And if you zoom out with some major historical events, you'll see that today's move wasn't that big. And so usually the way that I deal with the VIX is if there's a massive spike, that I feel like this event is a lot less scary than other massive spikes in the past. For instance, if we saw today's spike be anywhere close to what we saw back in April, I would be buying that dip with every cent that I have at that point. Again, it's not financial advice. It's just those moves, they tend to correct themselves fairly quickly. Barring World War III or, COVID 2.0 that actually is deadly, like viral Ebola, something like that. Those sort of things, don't just buy blindly into a VIX or any other fear and greed indicator. So that said, what did I do today? I did nothing. Well, almost nothing. Let me actually say that Robinhood was one of those that I had some underwater covered calls that just ran, and I rolled those out last week. This week, it looked like I would have to roll it out again, and Trump's post saved me. Now, I did not wait until we were under 140. I had some at 141, and thankfully I had some that weren't underwater at all. Instead, I basically set on my phone just some strikes where I'm like, hey, I'm happy to just completely exit this here. I'm not even rolling them right now. And so I did that. And so it cost me a little bit of money, not much, thankfully, because that's the nice thing about a big drop like that. Saved me a lot of money for rolling at a really bad strike next week, which would be really underwater. I didn't really want to do that. So those are free. Yay. It cost me a little bit of money. The other thing that I had done is I bought some puts or I bought some calls rather on the SQQQ. The SQQQ made a big move today, and let me pull that up too so we can take a look at this. What this is not a vehicle that you should ever invest in. At least that's the way that I see this. But this is an inverse triple leveraged NASDAQ. And so, of course, it has, if you look at it over time, this is why you don't invest in it long term. It's this green line here versus, I believe I have the NASDAQ on the other side. I do. Yeah, you can see the NASDAQ's been up 110%. This is down 97%. So it's a great way to lose your money if you don't know what you're doing. And of course, I did options as well. And we can see the triple leveraged inverse NASDAQ is up 13%, a little bit above 13% today with today's drop versus what we saw in the NASDAQ. And of course, I'm up some 450% in these SQQQ options that I have, which frankly, they've burned so much money because I've held them for a while, which they were a hedge. It's a small amount of money. I let my hedges, go. I don't try to sell them and get back money unless we see a massive move and they're deep in the money. Maybe we'll see that next week, but it just adds some extra protection. So today it almost reclaimed what I ended up buying those for originally. So those are really just flat on me, even though 450% sounds great. Now, if we get a big drop on Monday or Tuesday, those could be looking very good for me. And I'll use some of that money. I'll sell some, depending on what I'm seeing in the market. But this event here is not really that scary for me. We've seen the playbook already back in April. We see that things usually play out well. We know that the saying taco, which is Trump always chickens out, came from that time. Now, that doesn't mean that we're at the end of this. So one thing that I am thinking of, and what I would encourage you to do basically is figure out what your plans are on Monday, depending on if everything's worked out great and we're rallying, or if things are worse and it sells off into that morning. just kind of figure it out. Take some time this weekend. Don't, spend your entire weekend doing that. But have a plan going into Monday and then execute on it. Now, for many of us, the best plan is to do absolutely nothing. And that's what I actually did today. Didn't sell more puts. I didn't buy any calls. I didn't go into leverage. I didn't add any of my positions at all. I just let things play out. I'm like, hey, we can always fall farther. And frankly, the market was pretty extended on a lot of the names that I own and love. And I'm happy to let this play out. Now, Monday, I think that whatever move that we see, barring something over the weekend where it's like, hey, the talks are still on, everything's fine, that sort of thing's very bullish. Again, we might not recover all the way, but we will recover and have a very green day. But I expect that initial move Monday might not be the real move. So just be careful with that. We could see, and it wouldn't shock me if we open up Monday and we see further falling and further capitulation. A lot of people will think about this all weekend and be like, oh man, I'm up too much. I can't afford to be. And they'll have puts, they'll hedge, they'll be selling, and that'll cause a lot of selling pressure. There are also a lot of dip buyers as well. And so it wouldn't be surprising if we see right out of the gates that there's not really any different kind of news. We open up on Monday and the dip buyers come in. But I think either of those scenarios likely are going to be very, very aggressive. We might see something ridiculous like a 3% up or down on the S&P 500 or NASDAQ in that very opening moment within the first 30 minutes. And that's going to be something that probably will fade throughout the day, one direction or another, barring more news or something else that macroeconomically that hits. And so I might just fade whichever move it is. If we pop up immensely, there's not really been any news. I might take a little bit off the table with a couple of names that have run really hard that I have a lot of exposure on. And if we end up falling immensely and it just is aggressive and relentless selling, at that point, I think I'll begin to buy. I'm not going to buy everything all at once. There's certain names that I want to add to that I'd love to DC into that I don't feel like I have enough exposure in. So we'll have to see how those react. One of those is PayPal. I think PayPal has a lot of news. I don't know that it's going to move in the market will really shift the way that it's been perceived until quarter four earnings, which is in January. So it's a long time away. But we've seen it move and react in a very different way. And a lot of news, a lot of things I'm very excited about. And it dropped 8%, which tells me like, hey, there's some people taking some profits. That's fine. That's normal. It can absolutely drop back into mid 60s. I doubt we see 50s again. Boy, if we do, I'll rotate pretty hard into that too. But there's also other names too. I continue to add to BMNR. I wouldn't mind adding more Palantir at a discount, although it did not go down nearly as much as most bears were expecting today. Robinhood, I have plenty of. It's my largest position, so I won't really touch that. I don't plan to sell any either. I'll just probably sell some covered calls. Hopefully we'll have that big green spike, and I'll wait for that, and I'll sell some covered calls carefully there. But regardless, I plan to do basically just react depending on what happens on Monday, not make any major shifts in my portfolio. Now, if what happened today really caused you to sweat, you've got an upset stomach, that you're not able to sleep at night, what that really is it's a signal that you are taking on too much risk. Maybe that's leverage. Maybe that's some sort of margin. Maybe that's just being in a bunch of high beta names or not really taking gains when you should have taken gains. So what this is also for is it's an opportunity to kind of reset and think about the best strategy that works for you. Your strategy might not be my strategy or somebody else's strategy on the internet. That's fine. Just figure out what you're comfortable with, what lets you sleep at night. So like this day when this was happening, I wasn't upset. I actually ended up after about noon, I was like, I rearranged my office in case you hadn't seen. I'm like, let me focus on that. Let me put these strikes here on Robinhood. I'll check the market once it closes. And it's okay to do that. You don't need to be glued and have all the alerts going off and be consumed by that fear. If it's causing you fear, turn it off, look away. If you're happy with your positions, if you're looking for an opportunity, you can put those in. But regardless, I would not overreact necessarily to this news. Figure out what's right for you over the weekend and then go touch grass, as they might say. Go and enjoy the weekend. Beautiful fall weather in many places in the United States. Spend time with family and friends. Maybe drink some tea or lovely beverages, eat some good food, do some exercise, healthy things. Don't spend all weekend thinking about this. Just come up with a plan, figure out what's right for you. And if you've been taking on too much risk and you just can't sleep well at night, change your strategy so it fits what you want the most. Anyway, this has been a long one, but thank you guys for being with me through this. We're in this together, and thank you for watching, commenting, and subscribing. And until next time, happy investing.